Hello student, welcome to the lecture on capital asset pricing model, and after this lecture we will be able to learn the following objectives. Understand computation of specific cost of capital, explain measurement of beta, define other issues relating to the use of betas, describe differences between business risk and financial risk, define discounted cash flow approach. The capital asset pricing model (CAPM) helps us to calculate investment risk and what return on investment we should expect. Birth of a model. The capital asset pricing model was the work of financial economist William Sharpe, set out in his 1970 book Portfolio Theory and Capital Markets. His model starts with the idea that individual investment contains two types of risk: systematic risk. These are market risks that cannot be diversified away. Interest rates, recessions, and wars are examples of systematic risk. Unsystematic risk, also known as specific risk, this risk is specified to individual stocks and can be diversified away as the investor increases the number of stocks in his or her portfolio. The standard formula remains the CAPM, which describes the relationship between risk and expected return. Here is the formula. Beta. According to CAPM, beta is the only relevant measure of a stock's risk. It measures a stock's relative volatility, that is, it shows how much the price of a particular stock jumps up and down and compared to it how much the stock market as a whole jumps up and down. This is important for investors, especially fund managers, because they may be unwilling to or prevented from holding cash if they feel that the market is likely to fall. Computation of specific cost of capital. Computation of cost of capital from individual sources of funds helps in determining the overall cost of capital for the firm. There are four basic sources of long-term funds for a business firm: long-term debt and debentures, preferences, share capital, equity share capital, retained earnings. Cost of long-term debt. Cost of long-term debt represent the minimum rate of return that must be earned on debt finance investment if the firm's value is to remain intact. Long-term debt may be issued at par, at premium or discount. It may be perpetual or redeemable. The formula for computing the cost of long-term debt at par is: in case the debentures are issued at premium or discount, the cost of the debt should be calculated on the basis of net proceeds realized. The formula will be as follows, where K is equal to cost of debt after tax, I equal to annual interest payment, N equal to net proceeds of loan, T equal to tax rate. Cost of preference capital. Cost of preference share capital represent the rate of return that must be earned on preferred stocks financial investment to keep the earnings available to residual stockholders unchanged. Cost of preference shares can be estimated by dividing the dividend stipulated per share by the current market price of the share. Cost of equity capital. It is the discount rate which equates present value of all expected dividends in future with net proceed per share current market price. It represents the minimum rate of return that must be earned on new equity stock finance investment in order to keep the earnings available to the existing residual owners of the firms unchanged. Cost of equity capital is by far the most difficult to measure because of the following reasons. The cost of equity is not the out-of-pocket cost of using equity capital. The cost of equity is based upon the stream of future dividends as expected by shareholders, very difficult to estimate. The relationship between market price with earnings is known. Dividends also affect the market value, which one is to be considered. Cost of equity capital is measured by earning price ratio, where E is equal to current earnings per share, P is equal to current market price per share. The limitation of this method are: earnings do not represent real expectation of shareholders. Earnings per share are not constant, which earnings minus current earnings or average earnings. The method is useful in the following circumstances. The firm does not have debt capital, all the earnings are paid to the shareholders, there is no growth in earnings. Cost of retained earnings. Corporate managers and some analysts normally consider the funds retained in the firm as cost-free funds because it does not cost anything to the firm to make use of a part of its earnings not distributed to the shareholders. However, this is not true. It definitely costs the shareholders something, and this is an opportunity cost representing sacrifice of the dividend income which the shareholders would have otherwise received it and invested the same elsewhere to earn a return thereon. Algebraically, the approach can be explained as where K is equal to cost of equity capital based on capital growth method, TR is equal to shareholder tax rate, B is equal to percentage brokerage rate, CAPM, and discounted cash flow analysis. According to the CAPM, the appropriate discount rate for valuing the expected future cash owes a company or of a new investment project is determined by the risk-free rate, the market risk premium, and the beta versus the market of the company or project. Extensions of the CAPM. The capital asset pricing model has been extended in a variety of ways. Some of the best known extensions include allowing heterogeneous beliefs, eliminating the possibility of risk-free lending and borrowing, having some assets be non-marketable, allowing for multiple time periods and investment opportunities that change from one period to the next, extension to international investing, and employing weaker assumption by relying on arbitrage pricing. Measurement of beta. The systematic relationship between the return on the security or a portfolio and the return on the market can be described using a simple linear regression, identifying the return on a security or portfolio as the dependent variable Kj and the return on the market portfolio as the independent variable Km in a single index model. The CAPM useful, the capital asset pricing model, is an elegant theory with profound implication for asset pricing and investor behavior. The CAPM model is useful in several ways. We can examine whether real-world asset prices and investor portfolios conform to the predictions of the model, if not always in a strict quantitative sense, at least in a strong qualitative sense. Even if the model does not describe our current world particularly well, it might predict future investor behavior. The CAPM can serve as a benchmark for understanding the capital market phenomena that cause asset prices and investor behavior to deviate from the prescriptions of the model. Performance measurement. One of the earliest applications of the capital asset pricing model was to performance measurements of fund managers. The key idea here is that obtaining high returns by owning high beta stocks does not take skill, since investors can passively create a high beta portfolio simply through a leverage position in the market portfolio. Obtaining high returns with low beta stocks is much harder, however, since such performance cannot be replicated with a passive strategy. Investors therefore need to assess performance based on returns that have been appropriate risk adjusted. The CAPM provides a clear framework for thinking about this issue. Other issues relating to the use of betas. The stability of betas. Detection of beta stability is clouded by the fact that only the estimates of beta are observable. Changing estimates do not necessarily imply stable underlying betas. Robust estimation of beta. The robustness required for estimating betas involves weighing not only the outlying residual values but also the outlying market returns. It is found that the bounded influence estimator LP norm to be the superior robust estimator on the JSE. Dynamic estimation of beta. Filtering and smoothing techniques can serve as useful aids in the interpretation of time series of return observation. Techniques are available that categorize the movements in the levels of stock returns as either permanent shifts in the riskiness of the firm or as one of events attributable to specific circumstances. Differences between business risk and financial risk. Entrepreneurs understand owning and operating a business involves accepting a level of risk. Risk that your business may not succeed, risk that we may not recover investment. The amount of risk varies between business and is an important factor in determining a business value. Repeat, determining a business value. The two main types of risks small business owners are exposed to are financial risk and business risk. Financial risk. Financial risk refers to the chance a business cash flows are not enough to pay creditors and fulfill other financial responsibilities. The level of financial risk therefore relates less to the business operation themselves and more to the amount of debt a business incurs to finance those operations. The more debt a business owes, the more likely it is to default on its financial obligation. Taking on higher levels of debt or financial liability therefore increases a business level of financial risk. Business risk. Business risk refers to the chance a business cash flows are not enough to cover its operating expenses like cost of goods sold, rent and wages. Unlike financial risk, business risk is independent of the amount of debt a business owes. There are two types of business risk: systematic risk and unsystematic risk. Systematic risk. Systematic risk refers to the chance an entire market or economy will experience a downturn or even fail. Economic crashes, recessions, wars, interest rates and natural disasters are common sources of systematic risk. Unsystematic risk. Unsystematic risk describes the chance a specific company or line of business will experience a downturn or even fail. Unlike systematic risk, unsystematic risk can vary greatly from business to business. Sources of unsystematic risk include the strategic, management and investment decision a small business owner faces every day. Discounted cash flow approach. The discounted cash flow approach finds the value of an asset using its expected return and the present values of future cash flows. To find the discounted present value of an asset, it is necessary to sum the discounted present value of each future cash flow FV at any time t in years from the present time using the appropriate interest rate I. In the DCF approach, all future expected cash flows associated with the asset are discounted in order to find their present values. When using the DCF approach, the interest rate is assumed to remain constant throughout the entire period. This interest rate is commonly referred to as the discount rate when discounting values from the future to the present. Key components of a DCF. Free cash flow. FCF is often referred to as unlevered free cash flow as it represents cash flow available to all providers of capital and is not affected by the capital structure of the business. Terminal value. Value at the end of the FCF projection period. Discount rate. The rate used to discount projected FCFs and terminal value to their present values. Steps in the DCF analysis. The following steps are required to arrive at a DCF valuation. Project unlevered FCFs, UFCFs. Choose a discount rate. Calculate the TV. Calculate the enterprise value EV by discounting the projected UFCFs and TV to net present value. Calculate the equity value by subtracting net debt from EV. Review the results. Dcf methodology. The DCF method of valuation involves projecting FCF over the horizon period, calculating the terminal value at the end of that period, and discounting the projected FCFs and terminal value using the discount rate to arrive at the NPV of the total expected cash flows of the business or assets. Advantages. Theoretically, the DCF is arguably the soundest method of valuation. The DCF method is forward-looking and depends more future expectation rather than historical results. The DCF method is more inward-looking, relying on the fundamental expectation of the business or assets and is influenced to a lesser extent by volatile external factors. The DCF analysis is focused on cash flow generation and is less affected by accounting practices and assumptions. The DCF method allows expected operating strategies to be factored into the valuation. Disadvantages: the accuracy of the valuation determined using the DCF method is highly dependent on the quality of the assumption regarding FCF, TV and discount rate. As a result, DCF valuation are usually expressed as a range of values rather than a single value by using a range of values for key inputs. The TV often represents a large percentage of the total DCF valuation. Valuation in such cases is largely dependent on TV assumptions rather than operating assumptions for the business or the asset. Summary. Let us now summarize what we have learned in this section. The Capital Asset Pricing Model (CAPM) helps to calculate investment risk and what return on investment we should expect. Cost of long-term debt represents the minimum rate of return that must be earned on debt finance investment if the firm's value is to remain intact. Cost of preference share capital represents the rate of return that must be earned on preferred stocks finance investment to keep the earnings available to residual stockholders unchanged. Beta can in many circumstances be accurately measured this way even over a relatively short period of time provided that there is sufficient high frequency data. The beta coefficient of a security is defined as the ratio of securities covariance of return with the market to the variance of the market. Entrepreneurs understanding, owning and operating a business involves accepting a level of risk. Risk that your business may not succeed, risk that we may not recover your investment. The DCF method is more inward-looking, relying on the fundamental expectation of the business or asset and is influenced to a lesser extent by volatile external factors.